Okay, I see you guys tired. No power even to greet our speakers, but I hope we will bring some energy into the audience. We are starting now, but I want to basically know who are right now here in the audience. Raise your hand if you know what basically this RWA term means. Okay, we know at least someone. Okay, and again, raise your hand if you at least swap on any DEX centralized exchanges once. Oh, come on. Okay, good. We have someone who, at least in this industry, for those who are not really familiar with some of the terms that we are going to discuss, I would like you to think about the questions, because we start this panel, and then we will basically let you in and discuss all this possible questions or unclarity with our beautiful speakers. So 30 minutes for the discussion. We share some knowledges from our perspective, and then the floor will be yours. So guys, let's start from the small round of intros. Please introduce yourself, what you're working on, and one fun fact. Maybe the question will be around your fun fact.
Okay. Can you hear me okay? Yeah. Matthew Dawson, I'm the enterprise lead at the Ethereum Foundation. The Ethereum Foundation's main purpose is to steward the development of the Ethereum Layer 1 blockchain, but then there's a lot of other things that come alongside that. It's also very important that we engage with institutions, and both internally within the ecosystem and outwardly. So our team's role is to support everyone that is looking to build and adopt on Ethereum and its Layer 2s. Fun fact about me, I am a Liverpool supporter.
You said it's so silent, nobody here.
Is it too quiet?
Yeah.
Oh, I'm a Liverpool supporter.
Yeah. Yeah, Theo, the floor is yours.
Hi, folks. I'm Theo Golden. I lead the tokenization and digital assets work at Baillie Gifford, and I'm a portfolio manager. We are one of the biggest UK asset managers. We run about $300 billion of assets under management and have been doing tokenization for kind of near 5 years, and I've been in crypto for near 10. What is my fun fact? My fun fact is that my background, I was actually an opera singer before I came into finance. So I promise I won't sing, though. So.
Nice. Yeah, Antonio.
Hey, everyone. This is Antonio. I'm from Topnod, overseeing product design and product development. Right now, we are building a non-custodial wallet that aims to serve massive Web2 audience in order to bring the massive adoption, the real Web2 users onto the blockchain. Fun fact about me, I do fortune telling, and I did it before I started this project.
Really? So we have to talk with you afterward. Benjamin, the floor is yours.
Yeah, I'm Benjamin from Bitget Wallet. So Bitget Wallet have 90 million users, and we support on the tokenized stocks asset from their day one, and we are their launch partner. Of course, and Vantage Fusion, we trade via Vantage Fusion and landing in the Ethereum. So that's a good way. And nowadays, we surpass the total trading volume for 1.5 billion right now. And we are like over 90% of the trading volume for the Ondo tokenized stocks assets right now. So Bitget now is the big channel for tokenized assets. And we are really bullish on the RWA. We changed the exchange name from CEX to the UEX. We named it Universal Exchange. So that's the goal. And basically, I'm doing the BD of the Bitget Wallet, so other folks can reach out to me for that. Fun fact for me, I live in New York. If someone in New York we can hang out.
Nice.
That's a fun fact.
Great. A little bit of me. So I'm Sasha, 10 years in crypto, 4 years with 1inch, my first year in the RWAs. What 1inch is, we're, in terms of this topic, we're providing the infrastructure for the self-custody wallet to be able to trade real-world assets. And fun fact, before crypto, I wanted to become a chef, so I'm certified Le Cordon Bleu chef. We can discuss something about the flavors and food afterwards. And now jumping into the topic. The panel will be basically divided into 3 parts. Right now, I want to focus on what's actually happening right now. So there was a big narrative with RWAs, and now the RWAs, real-world assets trend happening right now. And I want to ask our colleagues from the different perspective. Second part is basically we discuss the problems, the quality of the RWAs, and how we can improve. And the last one, we will think about the future, and maybe Antonio will tell us something what will be happening in the future. That's basically the structure of the panel, and then we jump into your questions. Think about these questions, and let's talk about what's happening right now, guys. So there was a narrative. What was the basically enablers, and from your each individual perspective and expertise, how are you seeing the RWA's infrastructure and market happening? Who wants to contribute to this question?
Well, I think the panel just before us was stablecoins, and I think stablecoins are absolutely critical enabler to RWAs, because if stablecoins weren't here, then you would perhaps have some transfer of RWAs on-chain, but there would be like off-chain cash settlement. So stablecoins essentially offer that on-chain settlement leg, which adds to the overall efficiency gains. I think as we saw the adoption of stablecoins, that really took off in the past 2 years, and RWAs naturally following on. So I'd say that is one of the big enablers.
Thank you. And also, guys, I'm not saying just enablers. Maybe you can just share the situation in your, basically, wallets, Ethereum Foundation volumes, basically what's happening on the trade file right now. I'm meaning all these, basically, aspects. Theo, what do you want to share right now?
Yeah, I think one of the big drivers for RWAs right now has been kind of 3 main points. Firstly is that the depth of infrastructure, be that custody, be that transfer agency, really boring manual parts of the kind of traditional finance architecture have been replicated on chain, and you've started to see kind of both crypto native and TradFi players use their licenses, or in the context of crypto native, get licenses in order to provide those services. And that's really only kind of in full force, in scale, come in the last kind of 24 months. I think the second one is that, you know, there's a lot of us who have been in TradFi, who've been sitting in the dark corners of the office talking about blockchain and crypto for a long while. And we've started finding our feet a little bit. You've started seeing, you know, the likes of Joseph Shalom, who's now at SharpLink, but was at BlackRock, who, you know, was part of the Aladdin team, which is a piece of, you know, very, very big, kind of very boring architecture. He moved across to lead the digital assets team. You have these sort of people coming into seats where they start to have both decision-making power and more sway to get things done. I think the last one is also to kind of build on what Matthew said is you can't redefine or evolve an economy, which is basically what we're doing on chain, without building the blocks first. And so you can't build, you know, loan origination without understanding exactly what cash is. And that's the stablecoin play. But you can't not just define what cash is, but you need to have depth of liquidity. And you need to have depth of liquidity in something you can actually touch. And I think Circle have done a fantastic job of that, and starting to see more people like Agora, et cetera, coming on with assets which are structured in a good way and are compliant, which enables TradFi to actually come to the table.
Yep, guys, you want to add something?
And for us, especially when I'm talking to institutions and some of our institutional partners, one thing that excites us about RWA is, for the first time, crypto liquidity actually enters into the industry. And that's also, well, my personal reason why I'm doing RWA, because back in, well, 2015, 2017, 2019, we kept moving liquidity from off-chain to on-chain. So we have ramp service providers who are helping us to move liquidity on-chain, and when Bitcoins are mined, they are on-chain, and when people are buying Bitcoin, they are actually moving assets from off-chain to on-chain. And the on-chain world keeps growing, and it's huge right now. However, especially when I'm talking to the elder generation, when they talk about cryptocurrency, they kept asking me one question. What's the real benefits it brings to the society? Of course, I can talk about how stablecoins enable cross-border payment, and how how DeFi is actually empowering the whole financial system. And they'll say that's too far away from me. I want to see real changes, physical changes. And that's also why, one of the reasons why tokenized equities nowadays are very popular, because that's also a way when RWA comes out, the fund actually starts flowing into the real industry. For example, we were building some tokenized solar panels, tokenized charging stations. For those projects, actually on-chain investors are actually invest in off-chain assets. And those liquidity, those assets are actually utilized by off-chain entities who are actually building physical things that benefit society. I'm not saying the financial part isn't important, but I'm saying it's very interesting that for the first time in the past, it's off-chain we're bringing things from off-chain to on-chain, funds from off-chain to on-chain. And with RWA, it's the first time the on-chain world starts to actually giving back to the off-chain world. That's really building something, physical things that helps the society.
Thank you. Benjamin?
Yeah, about RWA's situation right now, because I'm based in New York, every day, every week, the New York has a lot of conference talking about stablecoins and RWA issue. And the conference have many participants like JP Morgan, Citi, and many big name bank, right? They all wanted to do that. So I came this time, I go to Hong Kong, and I also talked to some ETF issuers. And also the Hong Kong's like ETF issuer, they want to do the same thing. Right now, all the tokenized stocks nowadays on-chain is in the US market, right? Because of different region, they have a different license. They cannot bring like a Hong Kong equity on-chain. They cannot bring the Korean equity on-chain. But those are popular assets, like Chinese equity in Hong Kong, right? Korean equity, Samsung, etc. like that. It's really popular. So nowadays, many countries issuer wanted to deal with the license and bring its own chain, just like the US market doing. So as a wallet, we're gonna support as much money as possible equity on-chain, because we are non-custodial wallet and people can stay their money, use stablecoin to buy all the global assets. So that's our goal, and we believe this gonna be happen very soon.
Yeah, thank you. So the first part is done. We discussed the current situation, and we're slightly moving to the part which is about the problems, about the quality of the tokens, about the compliance part, actually. And basically, guys, you are forcing with the different types, I believe, of problems. Ethereum Foundation is working mostly maybe with the governments and supporting the ecosystem. Something happening on the treasury side. Equities is very popular right now. So what are the problems with that we are forcing? And I want to maybe highlight a part of the quality, it's fragmented liquidity issue, and also like the topic which is related to our RFQ/IMM pricing. So what are your favorites and what are the pros and cons for each individuals and how you see the perspective in this? A lot of things.
Yeah, I think we often, access to allocation. But usually it's like RWA or tokenization. Yeah. That's really, really broad. And so whenever we speak about liquidity within that context, it really depends on what exactly we're talking about. I mean, stablecoins in some ways are RWAs. Then we obviously have like pretty reasonable liquidity when it comes to something like a treasury or these instruments that are like cash equivalents. But tokenized real estate is also an RWA. And often, the biggest mistake I see is someone thinking that if I tokenize it, it will become more liquid. Just because it's been tokenized doesn't mean that some fractional share of industrial estate in another continent is going to somehow now be liquid. It is still fundamentally an illiquid asset. And so you have to really think about, right, what is the purpose of the tokenization? How do I benefit from it? It's not just from an increase in liquidity. That can be possible, but I think it's often actually about collateral mobility. And so the ability to, with collateral mobility, you essentially end up having less capital requirements in many cases, and that means that your capital efficiency goes up. And as soon as the institutions understand that, that's when they get really interested in it. So in that instance, you don't necessarily need the same thought of liquidity of like, oh, how much liquidity is in this AMM? How much is in this pool? You might be thinking like, right, what's the utilization of this lending pool? Because I actually want to be able to still hold that asset, but have some short-term liquidity. And even intraday, a treasury might use a stablecoin for some payments, swap that into a yield-bearing instrument, use it as collateral in something, and even more so as we move towards agentic payments and more automation, the speed at which this collateral can be moving to really squeeze out every bit of efficiency from it, I think will be really interesting. That's one aspect which touches on how broad it is. I think the other thing which maybe we'll discuss in the next section, or happy to come back to it, is right, how are you implementing this tokenization? Tokenized stocks is, again, very broad. So it can be a derivative, or it could be a wrapper, or it could be native issuance. All of this is very different. And if it's a retail participant, they might be pretty agnostic to it as long as the fees are cheap. If you're an institution, you probably care about, okay, what happens in the legal recourse around this? And if we're focusing on collateral mobility, how reliable is the infrastructure that this token is sat on, so that when I do need to move that collateral to meet a commitment at a strange out of trading hours on the other side of the world, I know that that transaction is going to execute and everything will work. So I think that's the big consideration as well, how these products are structured.
Thank you.
To pick up on the second side of that answer, I think one of the really important things that we think about at Baillie Gifford is about a question of respect, right? So in tokenized assets right now, we feel that a lot of the product that's in the market, particularly in the tokenized fund space, money market funds, haven't really been that respectful to the client base that they're catered to. And the reason we feel that is because the structure of those assets would never fly with an institutional investor in TradFi. So what am I saying? Tokenizing, creating an SPV, a special purpose vehicle, in the British Virgin Islands, and then going and buying shares and then tokenizing that structure, that simply would never fly for an institutional allocator off-chain. British Virgin Islands is a grey list area. Myself, as a fund manager in the UK, it's incredibly hard to even touch that asset, right? And I think you've then got two layers of separation from the underlying asset, and you've got potentially a startup in the middle with huge counterparty risk, which is divorcing you from your asset. So you are very, very dependent on both operational and data risk, but also technology risk, and also you've basically got a subordinated exposure. And what that has created is essentially a really low bar for what is acceptable. And I think this has caused a bit of a problem. So at Baillie Gifford, the approach that we take is that any product that we put in tokenized form into the market has to be as good or better, and better than anything that we would sell to, for example, a UK or US pension fund. We have to have the same level of respect for a MakerDAO as I do for a Vanguard, right? And what does that mean in reality? It means that it has to be a fully native issuance. It has to have on-chain books and records. It means there is no SPV or beneficial ownership structure in the middle. It means that when you own the token, you own the underlying assets, and that you have the full regulatory kind of rights and backing of the jurisdiction that you're working in. So I think this is a really big piece of when we come into the next evolution of RWAs. And I think the likes of particularly Superstate with their tokenized stock work that they're doing with native issuance, working with issuers, creating really high quality kind of issuer-backed assets. This is where we're going next. This is what regulators are going to want to see. This is the sort of quality that, but also buyers should be expecting. Don't settle for less. We should be giving you better.
Yes, and that's on the institutional side. And Topnod is building a retail product, so institutions have problems, and retail users also have a lot of problems, actually, when we try to access tokenized asset or to try to access Web3. We do have a lot of users around the globe and Web2 users, but when Web2 users come onto the blockchain, they face several problems. First will be understanding of all those complicated concepts, especially for non-custodial wallets, recovery phrases. Even though sometimes we do account abstraction for users, but essentially most of the users still need to understand the secret key, the recovery phrase, in order to protect their assets. Well, that's something that stops users from entering, especially when I try to introduce, for example, a non-custodial wallet to my friends. And they come, they see 24 words that they need to write down, They don't have a pen, they don't have a paper. And I'm telling, please do not take a photo of this, because that's will be a security risk. And do not write that in your online documentation, there will be a security risk. And that frightens them away. So that's very first thing when they enter. And even though I persuade them, I took a pen, I took a paper, here is your physical copy, you can write it down, and they register. And when they come into the wallet, what is Ethereum? What is Solana? And what are those different blockchains? Because in Web 2, when people come, they expect to see goals. Like, for example, I'm coming for investment, so should I see investment products? I come to trade, I should see trading pairs. But now when you come into your wallet, you see an EVM address, which is nonsense to Web 2 users. You see SVM address, followed by a code that's mysterious code, which I do not know what that is. And that stops user. So, well, I would say the UX experience should be when they come, they see all those products, they see touch points, and it should be intuitive. And when I try after, I explain to them, oh, those are the chains, and I can transfer you a Solana so you can start trading. Or I can transfer actually USDC so you can start trading. And when they try to trade, it says, insufficient gas. What is gas? When I'm trying to trade two pairs, when I'm trying to buy USDC, when I'm trying to actually trade, for example, trade tokenized gold with my USDC, something like I need a third thing. It's called gas, which never happened in Web 2. But Web 2 users, when they come, they do not understand. And that's the gas thing. After trading, when we check the history, there will be a long list. You use, well, I use 1 inch as an example. If it's on the native Web3 setup, you see there is 1 inch aggregator, which routes your money into Uniswap and takes a percentage in CowSwap for better liquidity. And bridged to Solana. On Solana, it also connects to Radium. Finally get a pair. It's a long, long, long way to go. And you paid 100, you get 98. And there is slippage, there's price loss. Usually at this step, if my friends actually endures all those things at this step, they'll say, fine, so I lost $2 today. That's the story, and that probably will actually stop them from exploring, because what they feel is like, I entered, I tried, I overcome all those difficulties, which I have never seen the Web 2, and I lost. So that's a huge problem that we need to solve. All those UX from registration, from the UX side, from on-chain trading, better on-chain trading experience, and from how we're displaying things to normal users. So in Web3, I have been in the industry for quite many years. What I see the growth curve, actually, it's growth slow at the very beginning because not very people believe in Bitcoin. Then there was a time around DeFi summer, it grew really fast. Then it's slowing again, because from what I see nowadays, Web3 is still a place considered for professional investors, especially here in Hong Kong. A lot of things are actually regulated, and it should be visible to professional investors only. The reason why is, indeed, it is for professional investors, because only professionals are able to figure all those out. They are able to take the risk. And that's the problem I'm seeing really today for retail end users.
Yeah, thank you.
Yeah. I will answer your question about IFQ and AMM
Yes, please.
education.
Yeah.
Okay, so there's several solutions right now in this area. So one is the S-Dog token. So S-Dog token is acquired by Kraken, and it's used in the AMM pool. The AMM pool is usually used in some main coin trading, and it lasts for many years. And our wallet, and it's supported for many years as well. And of course, 1 inch is doing quite well on the AMM side, right? And this solution have some issues about if you want to buy a bunch of tokens. Like for example, I want to buy 200K the tokenized dollars, right? The price is gonna be like a huge slippage. So that's the AMM pool have some shortcomings. And the IFQ system is using by Ondo Finance and maybe Superstay as well. So they use the market maker to fill the orders, and they will use the market price to fill the orders immediately and use the 1 inch fusion. And you have some model of a fast or the limit ordered model. So our wallet fully support that. So nowadays, if you're using a range fusion fast model, it will only cost like less than $1 fees. And just like you trading in the Fidelity and the BKR, that will be the same price. And about the gas fee, right? At the beginning, we using Ethereum. So the gas fees is super high. And we decided to cover it all because we suppose Ethereum 7702, that's standard. So Bitget Wallet is cover all the gas fee. If you are the wallet to trade on the Bitget Wallet and even the big exchange, you will not pay any fees on that. We pay the gas fee and using the 7702. And we also partner with the Ethereum Foundation for the gas sponsor as well. So we will continue to partner with many others, mainnets and many other layers. Of course, using the managed fusion and the managed solution to offer the a better user experience for the users. Yeah, that's my answer.
Yeah, thanks. And actually, we covered mostly, I believe, all the problems that we actually exist in because we have the representative with this expertise. Do you want to have a spice chat about the BNB/Ethereum Foundation, or we can take it out of the, how the volumes in terms of the data slightly moving, and if there is any plans for the Ethereum Foundation to improve the existence on the market?
Yeah, I think depending on the use case,
Yeah.
the sensitivity to gas pricing will be different.
Yeah.
Yes, the two key aspects is, if anyone, I think we still have this notion in our heads that Ethereum is expensive because a lot of us started using Ethereum and it was expensive. But it's a lot cheaper now with 2 hard forks last year and really the target to continue to 3x the throughput in the foreseeable future. But then what's really exciting is as you look towards something like zk'ing the EVM, the real scalability is really quite impressive. And that's before we even mention the L2s.
Yep.
So scalability through L2s, whether that's an app chain or general purpose scaling that enables significantly more throughput, means that you can still have these applications within the Ethereum ecosystem and benefit from the security of Ethereum. I think it's understandable that on the retail perspective, there's sensitivity to fees. If you're an institution moving billions of dollars, then you're sensitive to security and resilience, and you'd be more than happy to pay for that fee. So I think naturally, it depends on the use case, and Ethereum will continue to scale at both the base layer and the layer 2s with increasing number of blobs as well.
One thing to add to that is I think a lot of people forget why we do this bit of work, which is that the existing system we have is also really expensive. So the relative cost of Ethereum today, or whatever it is in terms of L1, relative to what you pay in TradFi, is still hugely cheaper. And I think what you're kind of alluding to it there, all we do it in TradFi, and I can say this because I don't run a platform business, I'm an asset manager, so I'm just managing the underlying assets, is lots of these, these platforms, they just abstract away the fee. How many times have you actually thought about on your Fidelity or AJ Bell or Charles Schwab, the platform fee that you pay or the kind of transaction cost? You don't really think about it or see it because it's abstracted away in a very, very friendly UX, right? And still comparatively, when you work and you build on chain, you are still seeing that kind of, all you're seeing today is the kind of live, in the moment rendition of what that does. And that's the beauty of disintermediation, is that you start to see the kind of ugly parts of finance. And now, over time, we'll improve it together. And actually, TradFi, we as institutions can come in and help with that process. We've got a lot of experience abstracting it, but we have to work together, right? So I think it's always just remembering where we've come from. We can't work on a zero-sum game basis. This is an evolution, not a revolution.
Yeah, and from the retail perspective, you mentioned Solana, there is a BNB volumes, Ethereum, overall. What are, from your perspective, being the distribution channel for those tokenized assets? How are you basically choosing, if there is any basically criteria to use one instead of another, or you're agnostic? Just
in terms of the chain level, to be honest, we don't care about it, and we shouldn't care about it because, well, when we're building a retail product, all we care is what user wants. Like 10, 20, 30 years ago, we're talking about abstractions. Things were also very complicated. When user wants to use the internet, they have to understand potentially DNS and to configure it. You need to understand HTTP protocol. You need a modem where you can dial in onto the internet. And at that time, Ant Group and Alibaba came into place. They did a lot of abstractions. And now it's similarly today. Ethereum, Solana, other chains are infrastructures. And users do not care about infrastructure. It's very, I would say it's very interesting. Web3, people love infrastructure. We invest in infrastructure. We can build infrastructure and issue a token and sell it onto the market. However, it has nothing to do with real users. If I want to use something, for example, if I would like to invest in, say, a tokenized stock, what I'm looking for will be the tokenized stock. But where that stock is and how that stock is built really does not, I don't care about it. As long as I am able to get the real tokenized stock, which has real value, which is really backed by Web2 stock, and that will be it. So for us, we don't care about this sort of distribution channel, but we do care about distribution channels.
I disagree slightly with that, is you'll really care when you have a Six Sigma event and you can't get your asset. And guess what? Those happen very regularly. They're not that rare. And also, so like the structuring really matters, because when problems happen, they manifest in a very ugly way. And the people who pay the most is retail. And that's not acceptable in a world where we're trying to build core, solid, reliable, secure, decentralized finance. And so we can't cut corners consistently. There has to be and I agree with you that it will take time. It's not a gradient. It's a very much a kind of an exponential curve. But we can't, every time we come with something new to market, we can't just cut the same corners that we did in the last process.
Of course. And well, that also proves that we still have a long way to go in terms of infrastructure. And I guess that also explains why we are focusing on infrastructure. We're focusing on things we haven't really achieved yet. Since we're focusing on infrastructure, which actually means we do need to still build those infrastructure, it will be very different if I'm building on Ethereum, or if I'm building on something I forked yesterday and launched, right? But in the long run, we are seeing we would like to abstract those part away for end users. When users come, they could choose whatever they want. It's just like I can choose to buy things on Amazon. I can buy things on Shopify. I can buy things on Taobao. I wouldn't worry that either one of those platforms will actually make me lose money because all those are proved infrastructure. Yeah. So actually, to make it more detailed, we do not care about what infrastructure it is as long as it is a proved infrastructure. So that will be more well-rounded in terms of this question.
Yeah, okay. Anything to add, or we can move?
Yeah, actually, what Antonio said, this issue about the chain and how do you get access of the assets, right? This situation is already, this is not a problem at all right now, because we have the aggregator. Like, I can swap a meme coin into a tokenized stock immediately, no matter which chain it is, right? Like when entry suppose over like a 50 chain or 100 chain, I believe, you can easily from Solana's meme coin directly go to the Ethereum tokenized stocks, right? So all the infrastructure nowadays are fully covered, but didn't cover the thing. The which one didn't cover is the gas fee. So I believe the gas fee is the main question, because every transaction, every contract, because I need to call the aggregator, right? Yeah. All the process, methods, all need a gas fee, because as long as the request, you will pay more gas fee, because the contract, that's what the contract design, right? So that's the only things we didn't figure out, but the rest of them, our wallet, our exchange, and maybe other wallet, and our aggregator partner already solved the fundamental things, yes.
In terms of gas, actually, I think recently on Base, X402 is actually thinking of solving the problem, and we're also trying to find a universal solution where gas is negligible on the blockchain. We still have to deal with gas. It's just finding a way where we allow users to not fuel, gas. So that's something we are thinking will be similar to traditional finance. You have Visa, you have your banks, you have all those service fees. Gas is more like a service fee. It's not an initiator of a transaction. Well, it is an initiator of transaction, but X402 solution or some other solution is actually with some infrastructure actually pay the gas fee for users first. And then we initiate a transaction, then if it's really cheap, we just let it flow. Or if we really need to take it back, we can take it back in later steps. For example, we can charge fees through 1-inch fusion or other swap protocols, or we can take that small amount of gas back later on when users are purchasing the assets. So the end value users are getting are still the same, but they don't really need to fill the gas. And that's something we are trying to work out.
That's super interesting. We covered the problems, and we're slightly moving to the future. Let's predict. Antonio, we really bet on you. Really, guys, like maybe a couple of words about the future. And I want you guys to be prepared to ask the questions, spicy questions to the audience. A few words on how do you see the real-world assets future, and we're from now, maybe in 5 years ahead. I know it's a long story short. Maybe you can adjust this period, but yes, let's talk about the future.
I think the initial stage up to now has been a lot about distribution. So they can take a product, maybe create a new product, and access a new audience on a new rails. But I think that is the first step to institutions already understanding that the longer-term game is actually operational efficiency and the ability to make better products. And the decisions around how those products are structured and the security around them is part of that better product. So I think that actually might lead to a world in which, while at the moment we'd say, oh, is this compliant, what the regulators think, it's actually, from a risk perspective, less risky to be on-chain and will become the favored way of structuring financial products and ultimately lead to better outcomes for end users.
Yeah, thank you.
Retweet. I guess the only thing I'd maybe just dig a bit deeper into it. So yeah, currently the play for a lot of managers and a lot of institutions is distribution, and for the likes of a fintech like Stripe, it's fixing cross-border, or for the likes of banks, etc., it's combating the threat of a neobank. It's very distribution focused. As Matthew says, the operational play has always been the kind of golden goose of blockchain, and to give you kind of a couple of examples, I think in the next 3 to 5 years, you'll have at least one major bank move their internal cash flows, which are in the order of magnitude of trillions on-chain, probably on a public blockchain, using a tokenized deposit, and then using kind of stable coins as a way of moving that into the outside of the bank walled garden. But simply put, it's going to be cheaper, and they have a very good level of visibility. So I think, yeah, you'll see a major bank using TDs on a public blockchain to move their own internal flow, and then that will expand from there. Second one is I think you're going to see, as you start to see good quality tokenized securities move, I think you're going to start to see a weird kind of merge between the fund architecture and vault architecture. I think you're going to start to see fund-to-fund structures being built for savings accounts, maybe that's for neobanks, built in vault architecture, because rather than having to build incredibly expensive fund-to-fund structures, which I have to go and charge 50 to 100 basis points, whatever it is for a fund of funds, I'm able to then go build a vault and charge 2, 3, whatever it is, because my operational cost is just orders of magnitude lower. So I think we might just see that fund model, and that's going to take regulatory agreement, but that merge of worlds. And then I think the third one is you're going to see, I think you're just going to see a kind of merging of TAMs between both centralized exchanges, decentralized exchanges, neobanks, and I guess like consumer-facing TradFi banks. I think you're just going to see that whole TAM become one, because ultimately all of them are going to try to merge into the same business because their distribution channel is the same. And I think what's really exciting about that is that we start to deal with some of the fragmented liquidity issues that we're experiencing in tokenized assets. But also, I think you'll start to see like some consolidation and vertical integration, and that's where you start to really build that kind of positive flywheel effect of cost savings. So I think those are three things that, like, particularly on the TradFi perspective, I get really excited about, because I get genuinely, I get to pass those cost savings on to investors, and that improves the financial outcome for the end investor.
That's really well said. And echoing on the third part, we actually do see there is, because we do institutional part, we do retail part, we do see there's a trend that things are merging. And just want to share something I read recently. I believe it is in the A16Z report or some institutional report. In the report, we actually mapped the growth of Web2 with the growth of Web3, mapping the first year of internet, mapping with the first year of Bitcoin. And we were trying to analyze all those different trends. And one thing that's very interesting is on users, the amount of users. If we map the growth of Web2 users with Web3 users, we'll see they are almost exactly the same by year. So each year, Web2 was growing 30 years ago, and Web3 is now growing, and the incremental amount of users are actually the same for those years. And if we are optimistic that things continue to follow Web3 growth trends, continues to follow with the Web2 trends, we'll probably see that by around 2030 or 2031, we might be able to acquire the first 1 billion users in Web3, optimistically speaking. So that's something I personally would love to work for, and I think all together, if we try to build all those infrastructure, we try to optimize all those user experiences with everyone together in Web3, I believe we should be able to achieve that.
Thank you. Benjamin, do you want to add something?
Yeah, the picture of the future, our future, right? I would say from the retail perspective. When I go to the Argentina for the Dev Connect, right? For the Dev Connect, I see a lot of people, they don't have the bank account, and their local fiat, the inflation is very high. So they use some stablecoin to secure their salary. And this is the fundamental things they wanted to do, right? And our wallet, nowadays, we are not a crypto wallet anymore, and we are named as a neobank. So we offer some payments infrastructure in South Asia, like a Vietnam, and in the Latin America, like Brazil. The people can use the QR code payment directly paid via their stablecoin. So that's the things happening right now. People can use their salary, redeem to the stablecoin, and use stablecoin pay the locally merchant, right? But in the future, all these users, those users who doesn't have their bank accounts, and they're suffering in the inflation, and they want to invest to the good equity, like US stocks, like the other region stocks, they will have the opportunity to buy on-chain. So that's population of those people who don't have the financial infrastructure. That population is huge. So I believe in Africa, Latin America, and South Asia, they will all join to this tokenized RWA revolution.
So we're heading to the 2030 to achieve the first billion of users, guys. I need your questions. We actually discussed all these levels. Who wants to ask the questions? Otherwise, I will keep asking these questions. Any questions? Everything was clear? Then, okay, good. We have a question. Beautiful. Yeah, thank you. Weekends, please, please. We need some sound.
Kind of curious, how do you see the future of finance, let's say, in 10 years, in 20 years?
The whole future of finance.
Yeah,
I can start.
Because we still thinking about traditional finance and decentralized finance, and one day they probably will emerge into something new. So I just want to, kind of understand your vision of that. When it happen, and will it happen, let's say, in 20 years, 30 years, and what would it be? How our life would be changed? How the life of the society would change? What are your thoughts? Thank you.
I think there is no ideal scenarios. Development should happen all the time, so we will improve all the time. Knowing our developers, they will never stop. They want to make everything as efficient as they can. But in my ideal scenario is it's a bank, again, some big bank or all our banks where we have two options. One is a traditional finance option, another one is digital finance, and it's acceptable and verifiable, compliant in the whole world. So you can either choose DGN, Anarchy, DeFi, DGN style, or you can do it in a normal, traditional way, and it should work very efficient together. That's my future of ideal finance world. Guys, what do you want to come in?
Before I moved, I started my career in management consulting in banks, and the last project I worked in was in HSBC on open banking. So open banking is a subset of regulation in the UK and Europe, which essentially mandates that customers can access or give their data to fintechs and other applications through bank APIs. That's a subset of open finance. And open finance has been a vision in, in the industry for decades now. And whilst I was there, I learned about Ethereum, and it was clear to me then, and it's even clearer to me now, that Web3 Rails enables true open finance. And I think that when everything has one settlement layer, one source of truth, and is verifiable, you can bring all of your financial life into essentially one platform, and then everything we've spoken about now in terms of operational efficiency, let alone self-sovereignty and security, means that it ultimately has much better outcomes for users, where historically finance, as many things have been about middlemen, rent-seeking, and extracting. We can remove that and have a more open and functional financial system.
Yeah, I would completely agree with Matthew. I think it's, I think we're probably underestimating the quantum of change we'll see over that time horizon. We always overestimate what we think will get done in 3 years, and we underestimate what will happen in 10. 20 sounds 2 times as scary. So I won't kind of put anything too prolific out there. I think just one or two principles that are probably helpful to ground ourselves in is that unified rails means shared, shared principles, but they don't separate us from personal preference. And there is a question about whether something is rent-seeking or something is adding true value. And I think for some people in the financial system, there is a level of interest, or they actually want their hand held. And so I think still in 10, 20 years' time, yes, we'll be working on a much more efficient, unified ledger. There'll be pools of liquidity that maximize economic growth and better financial outcomes. But you'll still have what I would see as a decentralization arc. There will be people at the kind of less decentralized end of that spectrum who value very, very particular things, be that they want their hand held, they want advice, or they want a certain very comfortable feeling. There are still people in this world that use checks, right? It's the same thing here. There'll be people at that portion of the decentralization arc. And there'll be people at the top end of the decentralization who are always the first adopters. And they will have, I guess, like the raw, always fragmented, ugly version, but they love it. Right? And they'll be at that point at the decentralization arc. And that principle isn't going to change whether we have a unified ledger or we have the existing banking system. And I think we've just got to, as a crypto community, be comfortable with the fact that preferences will remain. And we shouldn't judge people for wanting to use certain processes. But the underlying technology is going to create these positive flywheel effects and network effects, which they will still benefit from. I think the second thing I would mention is, and I don't want to be that annoying investor who talks about AI, but I think we will see essentially a redundancy of certain roles, particular within hyper-personalization of portfolios. I think my business, Baillie Gifford, we do investment management. I think what that's going to look like is that we essentially you have an AI wealth manager in your wallet, and they put together a risk profile for you, and you decide whether you want passive or active performance, and we send you live feeds of recommendations of what that portfolio looks like, and you start to look like how much are you involved in that process? I think you're going to start to move to something where human plus AI plus client have a kind of nice, uneasy balance of collaboration. And the answer is that as we build that on decentralized rails, you've been able to do that in a very innovative way, but you're also able to retain the sense of ownership, which is so important. Because ultimately, trust in an AI world is going to be even more scarce.
Well, I see some people are falling away. Let's talk about something
Talking
more.
about the future.
Yes, exactly.
You want to know more?
It's because TradFi is
In terms of fortune telling, not Web3, but in terms of fortune telling for the next 20 years, in the Asian culture, this year is the year of fire horse. Fire means innovation. Horse means moving fast. So in 2026, expectedly from a fortune telling perspective, this is a year where fast innovation will appear. And in the next 20 years, so because Val was asking for next 20 years, in fortune telling, the next 20 years are an episode or an epoch of fire. So the next 20 years will be an epoch of fire. And for those next 20 years, fire actually, usually we consider Web3 as fire. We consider AI as fire. Because there are 5 elements. So fire represents, I would say, internet technology. Fire represents innovation. So from fortune telling perspective, this year is fast-moving innovation. For the next 20 years, those are the years for the internet technology, for Web3, and for AI. And I'm looking forward to it.
Yeah. Benjamin, do you want to add something?
Yeah, I would say Happy New Year for the whole year. Wishing
Yes.
everyone get fortune.
Yeah, guys, actually, this is the end of the version of our session. I'm already tired, end of the day. But we are all working here for the first of billion of users. And I would like you, it's actually also your responsibility, or if you want to make our mass adoption finally happen, to educate everyone around. You go to taxi, you go to restaurant, you go everywhere, and just pick up one person every day, or at least a week, and then it will be faster than 2030. So educate, show the self-custody wallets, ask them to go to the Ethereum, talk about the actually tokenized treasuries that are there existing, and then we make this mass adoption happen. Thank you a lot for being with us. Thank you, beautiful panelists, for sharing the insights. It was really cool. And Happy New Year. Maybe you can just say Happy New Year in the Chinese language, so it will be very respectful.
新年快乐，新年快乐。
新年快乐。
Happy New Year, guys. Thank you so much.